You know, it's funny. Nobody knew why markets sold off so much on Friday. There was a lot of different opinions. Everyone has an opinion. I have heard the aliens are coming next week. If you guys know of that, please let me know so I can GTFO out of this place. Okay. I don't really know the safe place to go if aliens are coming or if they're hostile or not. I have heard that 10-year treasury yields were a part of the sell-off that we seen on Friday. I have heard that the algorithms just know something that we do not, and there's some kind of big disastrous news coming. I have heard that there's just low volume and there's not a lot of trading taking place today, so retail investors took over this market on Friday and sold stocks. I don't know. Okay, honestly, at this point, I would say all of that could be correct, including the aliens, because, what we seen on Friday was just pretty rare, okay? Where a market sells off that much, small caps down over 2%, Russell down 1.5%, S&P down 1%, and we just really don't know what happened. In this clip, you're going to see played next. It's kind of exactly that. Nobody really knows what happened to markets today, but they're giving their opinions. And the general conclusion is maybe markets have just rallied too much. We're in a low volatility period. And maybe we just seen a healthy give back. I will explain after this clip why I think we are in for a very strong period ahead. Why I don't think Friday was a sign of a bigger crisis ahead. And why you almost have to be bullish on markets. Now, obviously, it's not financial advice. Do what you guys want to do. You are free to make your own decisions. Historically speaking, though, if you are a historian of markets, as many claim to be at times, you definitely want to pay attention to what we're going to talk about.
Kind of profit taking after this year's rally, or is there more volatility and pain to come in 2025? Steve Grasso, what do you think? You're a big believer in seasonality, and where is it?
Yeah, so if you think about it, though, what did the market do from the election? We had tremendous amount of uncertainty. We pulled forward a rally. Market was up basically 8%. Bitcoin up 35%. So where do you go from here? I think everything gets pulled forward. So January, usually, what's the dynamic? January, half the month is positive, half the month is negative. So flip a coin on that one. You have a new president coming in, lower regulation, lower taxes, pro-growth. So where do we go for here in the market? Higher. And if you think about where we started from in October, we had no clue, or I should say September, we had no clue where rates were going to be. Mm-hmm. So we had that surprise 50 basis point cut. Then the markets rallied, and then the market said, oh my gosh, let's hold back on the election. We have no clue where anything is going to fall. So let's just see where the chips are going to lie. The market said, let's buy everything and anything and everything. And then who pressed pause on the rally? Powell. So when you start to really sit there and say, let me pull the reins back on the rally on the bulls, that's where we're at.
Yeah, January 20th, obviously, is a big date, Inauguration Day. And we are just about 10 basis points away from this year's high in terms of yields on the 10-year Treasury. I mean, that can't be overlooked either.
Yeah, and I think that's what investors have been looking at, right? So when you look at post-election, I think you bring up a lot of really good points here, where all of a sudden there was a lot of this broadening and this breadth in the market, and that quickly reversed, right? Everybody had this risk-on rally. They went right back to the Mag 7. But we are likely looking at this higher for longer rates are not going to come down as fast as everybody hoped. And that's really where you're seeing the market today. People are selling the Mag 7, which means they're taking profits from those things that have done really well. You're seeing a lot of your interest rate sensitive areas. So think of things like commodities, things like oil. Those are actually pricing higher or holding up a lot better in this market. And I think that is what you're going to start to see in early 2025, where I don't think this is necessarily a concern of where the tech trade is going forward. But are you going to see some rebalancing and see some profit taking? Absolutely. I don't think it's a bad thing for that longer term, but you absolutely want to have those inflation hedges. I think that's going to continue to be a story next year.
And Mike, today, volatility, the VIX was up 8%. We can't overlook that on a Friday.
Yeah, I mean, I have said before that sometimes if you think that a rally is overextended, that one of the things that you might want to look for are more of these sort of unusual moves where you're getting, a 1, 2, maybe even a 3 standard deviation move in, within a given day. I don't know that I'm really that concerned about what happened today. We've had a heck of a run, as Steve was just pointing out. I wouldn't expect to see a lot of people pairing their winners right before the end of the year if it's in taxable accounts, and institutions don't typically take them off their sheets, right before the end of the quarter, their winners, that is. So I think I'd be more inclined to be concerned about some selling in those winners. I think we're just in a relatively thin period here between Christmas and New Year's, and that could be contributing to it a little bit as well. I mean, if we get too many of these days, though, stacked up, where we get these big moves on a relative basis like we saw today and like we saw earlier, then I would get a little bit more concerned. 2 within the last 30 days, 45 days, not a big deal. But you start getting up to 4 or 5 2+ standard deviation moves, and typically that correlates to worse performance over the ensuing 30 days.
But yeah, it's clear from that clip, nobody really knows what happened on Friday. Now, there's also some news that came out at about 5 p.m. Eastern Standard Time on Friday that goes something like this. And this is definitely not great news. U.S. Treasury Secretary Janet Yellen says the Treasury expects to reach a new limit between January 14th and January 23rd, at which time it will be necessary for the Treasury to start taking extraordinary measures, meaning that they're going to hit that debt ceiling. They're not going to be able to issue new debt, and they're going to have to start balancing their books, okay? They're going to have to start kind of picking and choosing what they want to pay, more or less. Okay, that's not a great headline, although it's something we've kind of already known was coming. Like it's not brand new information. So I don't think this is part of, or at least a large part of the sell-off that we seen on Friday. If you guys want my personal opinion, I think it was profits being taken into the end of the year. It's not uncommon to see. And I think you're continuing to see this tax loss harvesting. So big tech got sold because that's where the profits are, and the rest of the markets got sold because of tax loss harvesting. Okay, something we've seen for a while now. If you look at the RSP, like there's been a lot of tax loss harvesting. Okay, now I think that sets us up well for January and for February when that tax loss harvesting starts to really come to an end, obviously, and the buying starts to, happen again. The buying of the tax loss harvesting. That's what usually leads to the January effect. Now, in a recent survey out on CNBC, 75% of fund managers expect that Mag 7 will underperform the rest of the markets next year. Now, that kind of helps to justify why big tech sold off more than the rest of the S&P on Friday. You can see the RSP, which is the equal weight S&P, what we have on screen here, has gotten utterly destroyed in September. That's not necessarily the case for big tech. Again, you've seen a lot of tax loss harvesting, but on Friday, the RSP was only down 0.68%, and on Friday, the headline S&P was down 1.05%. So almost 2 times larger of a decline than the RSP. That just means big tech sold off more than the average stock within the S&P. Okay, that is kind of a good sign, right? To see the broader markets not sell off as much as big tech. Now, I'll tell you why here in this video. You almost have to be bullish if you are a historian of our markets. If you like to look at kind of, if this happens, well, this tends to happen next, okay? Here's the best one of all. Percent of stocks trading above their 50-day moving average. It's currently at 35%, meaning 65% of stocks are currently in a downtrend. Whenever markets are this bearish, you almost have to be bullish. Okay, historically speaking, of course, as long as markets are in a bull market and we're not in a bear market and there's not some kind of huge problem going on, aliens do not ultimately come next week, you almost have to be bullish on markets. The last time we were this low was August 5th of 2024, when you hit about 32% of stocks trading above their 50-day moving average. That was the yen carry trade blow up. The S&P actually fell 10% at the lows. What happened? The S&P ended up rallying from there. That was the low. And you ended up going, from that low to the all-time high up 20%. That was a great buying opportunity. That was not the time to be bearish. That was the time to be buying. Before August 5th, it was April of 2024 when you were this low on the percent of stocks trading above their 50-day moving average. And last time you were that low, you ended up rallying from the April low to the July high, a 3-month rally or so of about 15%. A great time to be buying. Okay. If you want to look back to the time before that, the last time you were this low was October of 2023. And I think it goes without saying, what happened in October of 2023? It was a great time to be buying. From the October low to, April of 2024, markets were up about 30%. Every one of these times in recent history where markets have been this weak, it has been a good time to buy. I don't think this time is any different. Now, what's actually fascinating here is this is not really telling you anything about the market cap weighted S&P. It's not telling you anything about the S&P 500. It's telling you the internals of our markets are very weak. Okay. So whether whether right now is a good time to buy the headline S&P or the RSP, the internals of our markets, small caps, that's more or less what this is telling you. It's telling you that the average stock is weak, that you could likely see a recovery in the average stock. It doesn't necessarily mean the headline S&P is going to go up huge after this, although that has happened in all recent history, periods that I just showed you. I actually think in 2025, we're going to see an outperformance of small caps, of value, of cyclicals, of industrials. The equal weight S&P is going to outperform. That is the area that I think you want to be allocating new money to at this point. Okay. I think big tech is probably going to be sold off in January, which does create some headline risk, but you actually could see a broader market bounce during that time. And that is what I'm looking ahead to. Now, CNN Fear and Greed Index is in fear territory at 34. Very negative, right? Usually when CNN Fear and Greed Index is in fear, you want to be positive because inevitably things get better, okay? And that's kind of where we are now. Same is true with the AI Investor Sentiment Survey, as I showed in the last video. The historical average level of bears is 31.0%. Today, you're at 34.1%, so over 3% higher. And from December 4th, bullish investors was at 48.3%. Today, you're at 37.8%. Okay. Now, what I will also point out is earnings season does not start up again until January 15th. Right at the start of the inauguration. So I think you could get some volatility around January 20th. Earnings season from banks, could be a little bit on the volatile side. But all in all, I think between now and January 15th, there's a strong reason to believe we could see a bit of a rally in markets internally, right? A broader based rally, especially if 10-year treasury yields do come down. I think that was part of the sell-off that we seen on Friday with 10-year treasury yields that were up 5 basis points to 4.63%. Like that's getting up there, okay? That is not a very comfortable level to be at for equities to be as high as they are. Okay, so I think you could see 10-year treasury yields come down a bit, and that could help maybe support markets, although at this point it doesn't look like 10-year treasury yields will come down. I'm just optimistic and hopeful that they will. Now, beyond that, you really don't have much for economic data as well in the first 2 weeks of January, and Monday and Tuesday, right? The last 2 days of 2024, you really don't have any other data also. So really over the next 2-3 weeks, it's kind of a slow period. And usually when there's a slow period for markets, as far as data, no earnings, lack of data, that is, you do tend to see markets move higher. Now, 2025, I think the big question is, do we have a recession? Does inflation come up again? Does it get to a point where the Fed needs to consider raising rates? That would be an issue. If the economy weakens too much and it becomes an issue, then that's an issue for markets. But beyond those two things happening, I think markets are going higher from here. So historically speaking, this is the time in which you want to be buying stocks. But, who knows? Who knows why markets sold off on Friday? And that's a little concerning. So let me know what you guys think about this information down below in the comment section. Ladies and gentlemen, have a great weekend, and I will see you in the next one.